Energy markets remain a key driver of Canada's economy, influencing everything from the strength of the dollar to broader market performance. But with shifting global demand, changing supply dynamics, and ongoing volatility in oil prices, some of those traditional relationships may be evolving. At the same time, investors are trying to navigate what this means for portfolio strategy, sector exposure, and risk in an increasingly uncertain macro environment. Joining us now to break all of this down is Brendan Caldwell, Director of Caldwell Securities Limited. Brendan, thank you so much for the time.
Great to be here, Theresa. No pressure.
Now, do you think the relationship between the Canadian dollar and oil is structurally weakening, or is this more of a function of the current supply driven environment?
Well, they're going for counseling. I'm sure they can patch things up. Um, Historically, Canada has been the most normal petrocurrency in the world. Most economies that have natural resources as their primary driver are a mess. Natural resources are to economic growth what wine is to dinner, perhaps. A wonderful complement, but a dangerous substitute. So that if you're totally dependent on natural resources, you're really at the whim of world demand. Now, Canada, because it has had historically a more balanced economy with financial services, technology, industry, the natural resources, including energy, have been a wonderful balance. And because oil is so volatile, to use the word, it has caused our dollar to also move up and down. Uh, it's not as big an influence as interest rates, but it's still a big influence. And of late, our dollar hasn't been moving up, with all of this supply constraint and the spike in the price of oil. And I think there's a bunch of reasons for that. But what it has done is allowed our dollar to remain reasonably consistent, albeit in the low 70s, which might be the sweet spot for us. If you get up around the 90s, there's a real economic slowdown, and you get down towards 60, the loonie more closely resembles the peso. And I think, while it may not have caused the dollar to go up, energy has at least kept our dollar relatively stable.
And how should investors think about Canada's sensitivity to energy prices?
Well, it's a funny thing. Our dollar and our economy tend to do better when the price of energy is demand driven rather than supply constrained, which sounds really inside economic baseball. But right now, the price of energy, oil in particular, has spiked so high because there is a supply constraint. They're just some large percentage of the world's oil isn't passing through the Strait of Hormuz and out into the world. So the overall price of oil globally has gone way up. But it's not because we're making or manufacturing or there's robust economic growth. It's because one key supplier has been knocked offline. So it doesn't really benefit Canada too much directly. And from an investment perspective, temporary shocks and all political events like the one we're going through now, as tragic and large scale and no newsworthy as they may be, they are all have temporary effects on the price of anything. So people do invest and think about temporary shocks much differently than they think about broad economic trends. So if this was a really robust economy and the price of energy was spiking because of that, it would mean likely new investments, maybe new pipelines, and yeah. What it also has meant that big international companies with a relatively low dollar and big supply of energy are looking at Canada. I mean, ARC Resources has just been the subject of a proposed takeover by Shell, the big international energy conglomerate. I wouldn't be surprised to see more of these types of deals being announced because, like with anything resource based, our energy sector is relatively inexpensive on global terms, and there's a bunch of reasons for that. One of which is we seem to have a hard time getting it to blue water. I see that new pipeline that was just announced by Enbridge takes more of our energy and sends it to the United States, which is very different than perhaps Mr. Carney was talking about, looking for other places to do business besides our largest trading partner to the south.
And do you think global energy demand is being underestimated?
Yes, in a bunch of different ways. In that, eh, over the next number of years, next few decades, there will be, I think, a big transition from fossil fuels to other forms of energy. Some of that may be nuclear. And if I just pronounced that like Homer Simpson, I'm sorry. Um, and But some of it will be renewables. I think solar energy, the increase in the demand for solar energy was, I think, the biggest single increase of any of the sectors, bigger than natural gas and quite a bit bigger than oil. Um, I mean, that's partly because the demand for electricity, without being intermediated through gas or oil or anything, has gone way up, and the electric car is coming. I mean, it's here, but the only thing that's really keeping it from dominating North American roads is we don't like the fact that the cheapest and possibly the best electric cars are not made in North America. So it's more of a trade issue than it is an environmental or anything else. Um, but between now and then, you're seeing a bit of a puff in the price of fossil fuels because um, there's not as much exploration going around, and there'll still be huge demand, particularly if we ever manage to figure out how to live peaceably with one another on this planet.
And what sectors act as a natural hedge to energy exposure across different macro environments?
Well, which is, I think, another way of asking perhaps what sectors are likely to be the hardest hit if energy goes up. Well, industrials, of course, would be one. Transportation is a monster hedge, if you will. The Air Canada, for example, but all the airlines have been hit very, very hard because they've had to cancel routes, not just for the uh, reasons of the war going on in Iraq or the conflict going on in the Middle East, but also because they just can't get the same jet fuel. So it's become increasingly challenging to travel anywhere. So that's one. But industrial companies as well, manufacturing, with the price of energy, which being the big cost, particularly for a lot of manufacturing, I think that would be one. So how would that be a hedge? Well, right now the price of energy is so robust. If peace were to break out in the Middle East, and pray that it does, and the price of energy were to come down, you can see a significant spike in transportation stocks, Air Canada, other airlines, as well as industrial manufacturing stocks that are largely dependent on energy, and the price of energy when it comes down really benefits those.
And Brendan, are we seeing a shift in how global investors view Canadian energy assets compared to the past decade?
Well, yeah, I think so. I think, as I alluded to, I mean, the Shell Arc Energy announcement today would be an example of that. I do think that, I mean, we're quite long. That is to say, we own quite a number of positions in energy stocks. Tamarack Oil and Gas is one. Um, there are quite a few others that are both the bigger players, like a Suncor, but also some of the up and coming energy companies could be in play, or at least will continue to do well, because I think the demand for traditional energy supplies, including even uranium like Cameco, will be considerable for some years to come.
Well, Brendan, thank you so much for the time.
Thank you, Theresa.